Welcome to the Gray Report. The hunt for Red October is on. This week on the Gray Report, if you're a multifamily investor, active, passive, somewhere in the middle, sit back, relax, pay attention. We've got a great show for you today, breaking down all the latest research reports, information, data involving anything in the multifamily industry, commercial real estate, and the macro economy. Some great pieces. First, the Federal Reserve, they've got an Instagram account. Big news. What are they messaging and why? Piece from the Mortgage Bankers Association, taking a little bit of a deeper dive into what are banks doing, how are they looking at it, what is the makeup of some of these loans. A piece from BizNow on the idea of these discounted payoffs. Is it going to fix things? Probably not. A piece from the Harvard Joint Center for Housing Studies. Home prices, interest rates, they are still rising. If you had not heard, Apartment List has an excellent piece, as well as Business Insider. Going to stick around to have to catch all of those reports and analysis from the Gray Capital team. All right, let's get into it. Welcome back to the Gray Report, live from the Gray Capital Studios in cloudy Indianapolis, Indiana. Yeah. Joined again by Dr. Matt Bosnagel, Hello. Head Researcher, Director of Communications and Marketing at Gray Capital. Matt,
hey,
how's it going?
Pretty good. And explaining this over the past day or so, that gathering, it's been a little more tense this week.
Feel tensions rising?
Yeah, I think
in real estate market
things are getting cooler.
Why?
I don't know.
Is there a reason?
yeah, but you can feel the season changing. This is
Air's getting a little
pathetic
drier.
Fallacy at its finest. Really, the air is changing. That people are talking about things that they weren't talking about a week ago. And people are starting to think, what is 2024 going to be like? And is it going to be if it is anything like 2023, then that's a problem.
Yeah. Well, the winter has been long, Matt. While it was sunny just a couple days ago, it has felt like a winter for commercial real estate and, most parts of the economy over the last year. I remember, last October, we were talking about multifamily winter, rents declining, things slowing down for a whole year after that. And it doesn't feel like, we're in March. It truly feels like, we're in October once again.
It's good of you to mention that too, because even on the rent growth side, it is very similar to last year, if not perhaps a little bit worse.
So the escape of Groundhog Day, I think, is the ambition for all of us. And it's, not to get too much on the inside baseball, but it's certainly, for us at Gray Capital, it gets us to try to think differently and, what can we do? For me, asking the question myself and for the team of, okay, what we've been doing the last year, how well has it been working in terms of, finding deals, our strategy, just from a, multifamily acquisition standpoint, just our own internal businesses and our operating companies, what can we do something different?
Yeah.
Is there a new way? Is there a different way to transact? Because obviously what we were doing, a couple years ago isn't even an option. The types of leverage, types of deals, the market looks different. We're looking at some really, not necessarily, novel strategies, but just executions that, we never really would have considered months ago, certainly not, years ago. I mean, we're looking at doing all cash deals possibly, we're leaving that door open, which is most people never consider, because usually, leverage is key to real estate. But the financing leverage is what's screwing up real estate right now.
Yeah.
And if we can buy some great deals at some great basis, because that's what we're starting to see. But Matt, I mean, if you put a gun to my head, we still have another probably 10, 15% of value declines still to go based on everything that I'm seeing. And man, if rates stay high, which is certainly the consensus is, what is longer, some in my long is years. Some people, when they say longer, it's like months.
Yeah.
To me, it's years. But that changes a lot of, we talked about earlier, transactions are the lifeblood of real estate, from an operating revenue standpoint. brokers, if they're not doing deals, they're not bringing in money. Syndicators, if they're not doing deal, they're not bringing in money. Major firms, they're operating paycheck to paycheck on deals, paycheck to paycheck to pay payroll. Mm-hmm. A lot of these firms hold a lot of deals. They've got money in the bank. They've got reserves. Some have been more proactive than others, but it is, it's going to be challenging out there, and it's a war of attrition. Mm-hmm. The longer it goes on, the more potential pain.
I'd like to return to this, or if you want to keep talking about this before we cover the next.
No, let's talk about it later.
Man, has that been on my mind?
Yeah,
you started talking about, and I was like, okay, good, because I have got a wellspring of thoughts about this.
Yeah, no, let's talk about it later. But first, Matt.
Yeah.
Major social media news.
Some happy news.
Some happy news. Some fun things.
Yeah.
The Federal Reserve, in a major step, of only 5 posts, has joined Instagram. Matt, it's interesting. Jerome Powell coming out and saying, hey, he's the chairman of the Federal Reserve Board, and they've got an Instagram account. They're going to be giving us updates. From a Fed that back in the day, would never communicate about anything. They're really seeing, as we've said multiple times, Matt, their ability to communicate to the public, to markets, as, really primary function, a tool for monetary policy.
I was just going to say, you took the words right out of my notes again.
Sorry.
No.
Or no notes.
Oh, well, no, I handwrote these. I handwrote these notes.
Doesn't count.
Yeah, for sure. But
Matt, why do they need an Instagram account? What do they need? What are they communicating?
You totally hit it on the head. It is their role. Yeah, sure. They can do actions, but they also have to communicate those actions. And part of the action themselves is like the kind of persuading that they need to do that, for instance, they're serious about rate hikes, or what I like to think in this Instagram is that they are flesh and blood human beings, open to all the weaknesses and biases that any human being, mortal or otherwise.
I actually think, Matt, on the a lot of the comments, this is all in jest, but a lot of people didn't think it was necessarily even real. They were thinking it looked like a deep fake or an AI. And I think that's just in jest and on theme with what people are talking about these days. But
it is interesting how he doesn't really, there's no movement. So it could be AI. It's not a complicated shot.
We can't get the chair. We can't make time for him. Can we just do one of those deep fake things? I mean, they can.
He'll sign off on it. He just doesn't have the time.
I mean, they've got the money. They've got the ability to print money, unlimited amount of money. They're, press of a button, type the numbers in a spreadsheet. They can probably find the budget for some deep fakes. So, but Matt, though, the question is, again, this is going down the conspiracy theory rabbit hole a little bit, and for fun. Mm-hmm. But is there some anticipation that the Federal Reserve is going to need to communicate with the public via Instagram? They say it's because October is financial literacy month, financial education, personal finance month. We're supposed to learn about finances.
My first thought was that they are kind of anticipating backlash due to like a future decision or something that they see around the corner that they're going to blame them for. But then I was thinking like, well, but this kind of puts a little bit more of a target on their back, because if more people know what Jerome Powell looks like, or he's kind of spreading his message, and they're like, oh yeah, I was thinking about the Federal Reserve. I don't like the way they're handling the economy. If it's putting them top of mind and things are going wrong, then then things could backfire if they're trying to use this to soften their image. I think that more practically, it's probably, just a communications tool. But there's got to be a reason why they're doing this.
I mean, I'm sure at some point somebody said, it's like, why don't we have an Instagram account? It's easy, it's like anybody can open an Instagram account. So it's like, maybe it's just like I might as well. They probably didn't have a website for a while. And they were like, why don't we have a website?
Yeah. And it's certainly, if what is education, but, bringing the information to new groups of people that don't already know it. And there's probably a way bigger pool of people that don't know what the Fed's all about on Instagram than there is on like LinkedIn or something.
Mm-hmm. Yeah.
But that's a little bit of speculation. I don't necessarily think it's a bad thing.
No, I don't see it. I don't see it as a bad thing, and it's just more of a.
It's a funny thing.
It's a funny. It's a curious thing.
Yeah,
you know, it gets you asking questions.
Yeah,
and
it's more stuff and messages that we can pour over his minute facial expressions.
Well, exactly. It's like, you know, just another way to read the tea leaves.
Mm-hmm.
What is the Federal Reserve Instagram posting, like it has any connection to, you know, FOMC.
Hopefully they do like the, you know, today is National Secretary's Day, or, you know, all those Hallmark holidays and stuff, that they can kind of track those with some daily Federal Reserve posts.
Yeah. You know, like bring your pet dog.
Yeah.
The office day, and you know
they have pictures of everyone in the staff over their computers.
Yeah, that'd be good. Okay, Matt, let's get into something a little more serious. Could discounted loan payoffs be what finally restarts the CRE debt market? Matt, you're gonna have to explain this one. What is a discounted loan payoff, and why could it restart the CRE debt market? Wow.
So, you know, as I was kind of going over this stuff with you, and this really sets the tone for what I've been thinking about this past week. A little bit of what you were talking about before, when you were talking about what syndicators and brokers and just the low apartment sales volume as such a huge story of this year. But this is my thoughts of like, well, what's the way out? I almost titled the newsletter this week, like, when is multifamily going to make sense again?
Yeah.
And who's going to help make it make sense? And one group of people are the lenders, who, if they, and I feel a little bit, this isn't sadistic, but it's like, I am hoping that the lenders are strict. I'm hoping that they don't let the people that have bad loans. Now, again, this seems callous, but I'm hoping that they don't give them a freebie. And instead, their way out is not going to be through negotiating with banks for accommodations. It's going to be through selling their property at a lower price than they already would. Yep. So there is a release valve out there for these people, and it doesn't have to be the banks. And there are plenty of buyers out there willing to make that purchase.
But is that if they sell, though, while that is an exit, it can be a painful one. And you know, if the bank is, you know, if they're willing to at least work with them or delay, you know, just that avoidance of pain, and if they know there's going to be pain, if they can kick the can down the road a little bit, again, you know, I think there's going to be this hope out there for a long period of time that if we just wait a little bit longer, maybe rates will come down. Just a little bit longer.
I was just going to say that you were talking about hope, and how, you know, hope can be a month long, a week long, or a year long thing. And some of the other reports that the apartment list report will illustrate how, you know, if you're looking for cash flow, the apartment rents are going to be pretty low for this winter. So you're going to have to keep hoping for a lot longer. And during that time of hoping, that might feel good, but you're going to be losing money, and it's got to hurt. And this pain is, you know, and I keep going back to the seasonal metaphor, but you know how it always seems like it's summer, and then one night it's like freezing, and that's what it's going to be like. You know, it says in this BizNow article, you know, still extending, still pretending. There hasn't been a crisis point that is going to kind of snap people out of it. And I was talking to you just before this and said, you know, is recession what's needed to snap everything out of it? You know, I think that compared to like a few months ago, I think recession seems to be a little more likely. It seems like things are fluctuating a little bit differently. But back to this article, this is all an aside. I've been thinking about this issue a lot, as you can see. But banks, these discounted payoffs are essentially when lenders are allowing borrowers to pay off less for their loan, and then they market, all right, you're good, than it is before. It's a very simple thing that functions
just like settling an amount of the debt. Like, I mean, maybe people are familiar with this. Like, if you got like a debt collector that's calling you, and they're like, you owe this medical bill, and you can like negotiate that down. You know,
and
a fraction.
To me, I understand it
a little bit.
Yeah, to me, I understand it. It's like a risk. It's like a risk mitigation strategy over, like, I could maybe not pay you over a longer period of time, or I can guarantee,
80% or 90%, but you're going to get paid, and you don't have to deal with the time. You don't have to deal with it.
Yeah.
I'm sure they have to deal with it, but it's not as extended and drawn out.
Yeah.
You have to be in special servicing. And, but I imagine though, if you're a borrower that does that, you're not going to be on like top of the list for banks to lend to in the future.
Yeah. So that was one of the refreshing comments from some of the sources cited in the article, was that, our frustration right now at borrowers or owners operators for living in 2021 and thinking that they can get low rates or thinking that they can get high prices is shared amongst, I think, plenty of bankers. These same people that are like, well, yeah, why can't I just sell for 2021 prices? Those people that we are seeing in the sales market, they're going to their banks like, well, why can't I just get a low rate? Yeah. And it's like, that's not it. Yeah. You can't live in the, so they are hoping for they are almost delusional, it seems like. And again, I'm letting my frustration bleed through here a little bit, but fortunately, as this article points out, these discounted payoffs are a long way away. Banks have to be in a little bit more trouble where they're just like, okay, yeah, give us the money.
Yeah, they're not there yet, but it's good to put it on, again, like put it on the board, put it on the wall of like, that's an option that could happen, and we could be seeing that at some point in the future.
Yeah. And the way that they frame it is that banks are likely, especially at this point, they're unwilling to take the losses that discounted payoffs require. It's a mark against them. So it's not as if like it's in any way a win for the bank. There's an inherent disincentive that I think kind of counterbalances that incentive of like, well, there's a lot of like the best bad choice. That, there's not in a lot of situations today that I'm seeing that if it's requiring a transaction, there's not a lot of outcomes that are like, ooh, we're going to look really great in this scenario. It's like, what's the least amount of pain? It's like, there's not going to be pleasure's not involved in the conversation. It's what is the least amount of pain that stops bleeding. Yeah. And I keep thinking of that. What was that phrase? Like if you owe the bank $1,000, it's your problem. But if you owe them $100 million, it's the bank's problem.
Yeah.
And I think it's a little squishy in between. Yeah. And from the comments on the article, it's like they're like borrowers are acting like they're in the driver's seat. And I don't think, and I personally, that wasn't the article, I personally don't think that can last for very long. Yeah. Because it's there again, like I said, like there are options for borrowers just as well as there's option for banks.
And some of those options, again, are options, and it may be less painful than handing the keys back. Yeah. But, a lot of the rescue capital, preferred equity, again, it's a lifeboat, but it's like you have to abandon like ship, like the investment, and like you'll maybe survive and live, and maybe not lose all your money. Maybe you'll break even. Yeah. But there's no the idea of that 15 IRR and 2x. If you start recapitalizing that way, you're often really chipping your returns, by a fraction. And so it's like, it's going to the bottom of the ocean, and you're just on the lifeboat hoping to get to shore.
Yeah. Yeah. I think that, and this kind of plays into our next source that we're going to cover. I keep thinking about the frame of mind of banks, and do things have to go very poorly in order for them to give concessions? That doesn't make sense to me, because if things are going poorly, they're going to want their money. As
they could always just say, hey, we want to foreclose on you.
Yeah. Yeah.
And they don't want to manage a bunch of real estate, but like, that is an option.
Mm-hmm. And that's and that was the other point too, is that, a lot of them aren't set up to operate these assets in any degree. And, I wonder what the trailing effects of this is going to be if banks are going to be overloaded with multifamily assets that they don't really want.
They could be, and it's operators like Great Capital where we're hoping that, and we're doing the groundwork to get the call from a bank saying, you guys want this, we've got a great deal, but it needs to be taken off our books. You guys want to buy it, X cents on the dollar. Maybe wishful thinking on my part, but
and we can see the scale of this is there are a lot of loans that are out there, and not everyone's going to find a way out. And I couldn't find an article about this, but it is the other thing that I've been thinking of is Yeah, so maybe borrowers with loans coming due, that could provide relief. They'll sell for less. But what if, new builders, or, you're putting more product into the market? How much is that going to affect the prices? And interest rates have just squeezed the nozzle so there's just a trickle of new deals, and there's not enough information out there, and it's so difficult to see what's going to have an effect right now.
People are getting more desperate.
Yeah.
I'm just in the last week, we're getting calls, texts from brokers and owners, and being like, "Can you put in an offer? Can you please look at this? Like, what's the number?" We're not there yet, but we're definitely getting some desperation. Jay received a text message today. I mean, the quote was, "It got very well in the industry, seen a lot of deals, and it's a shit show."
Yeah. Well, and I was, another thing that informed my thinking, it was Addison who was talking to a broker too, and was like, "Listen, we don't know." And they were sharing what you said earlier, is like, these transactions are keeping the lights on for people, and now there's none of them. And is 2024 going to be exactly the same as 2023?
Yeah, and we hope not, but it could be, and that's the long winter or war of attrition that I'm talking about. And you take, you're talking about low maturities a lot. Take the low maturities thing out of it. Let's just say that, like, it's this winter, this slog when nothing can happen, deals don't get done, the transaction volumes are lower. It's an existential threat to most operating real estate businesses, because most operate at a loss from operating revenue. It's transaction fees that keep the lights on in a big way. If you have no recurring revenue, so for every group that uses third-party property management, that contracts out, where's their money coming from? Maybe a little bit of an asset management fee that doesn't.
If they use third-party
lights on.
Third-party property management, and their rent's going to the investors.
In most companies that have even in-house property management are operating at a loss.
Yeah,
it's fine. It's fine if you're doing multiple deals a year, you're selling deals, and you're making hundreds of thousands of dollars on acquisition fees. You're making $1 million, and you sell a property. It's when the market is going up, or at least you're able to. It doesn't have to be hot, but just if it's working. Yeah, that it works and sustainable until all of a sudden the market turns off. Yeah, and it's not. And so, I mean, it's something that we've been focused on for a long time. How do we batten down the hatches? Build up the reserves, add recurring revenue, so we're in a really good spot. So we can make payroll and literally keep the lights on. Yeah, but it's the whole industry is thinking about all these brokerage firms. Think about the brokers. They're living off.
Oh yeah, that's the first one I think of, but I think you make a good point. And like syndicators, that rent going to investors. It's not going into largely the syndicators' operations.
Sure, hopefully, And there's some bad actors will probably be showing their true colors here in desperation. I think there's a lot of skinny deals that are deals that should never have been done, but people are probably convincing people to do just to get another couple fees or not. But it's if got to, how else are you going to keep the lights on? Yeah, and
it's a whole lot easier to hope for the best than planning for the worst. Yeah. And I think that the timer's going to run out, and that's, at least that's my hope, and maybe that's misguided. is that eventually people will get real. And
I don't hope for the the demise or anyone getting out of the business, because I love the industry and there's so many awesome people in it. There's been a surge of syndicators and new entrants to the industry, and in years ago we were included as a newer entry into the syndication world, and we've had more years to season, but and we were able to do a lot of great things in between then and now. But a little bit of culling of the herd, it was too easy of a market just to do any deal. Cap rates compress and it goes up in value. We need a little bit of competition. We need a little market reset. And I think the strongest are going to survive. And I think that we're trying to make the right moves right now so we can get to the other end, live to fight another day. But also, sharpen the axe and, loading the magazines and, building the trenches. So the trenches have been dug. And, so when the time's right, we have all the resources necessary, and we're still sharp. The hardest part for us is the atrophy on deals. I mean, we've gone through multiple recently, kind of like dry runs of almost like drills of like, let's get ready to go. We're not sure if we're gonna get this deal, but like let's pretend like we are. So we got to be sharp. It's game time. We can't be caught flat-footed. So we're not get a deal for another couple months. Maybe we'll get a deal in 2 weeks.
Yeah.
I don't know.
I still that, again, to bring up like builders, so maybe loans aren't it, but we have built, and there are a million units under construction right now.
Yeah,
those are gonna enter the market. I don't think that all of those builders, I would say most of those builders don't want to be in the business of operating. They want to get onto the next thing that they're building. And at the very, practically they can't operate all of those probably unless we see every single builder in America become a multifamily operator. Ain't gonna happen. So what's gonna happen then is they're going to try to sell it. And as those accumulate, then that may have an effect on prices as well.
The developers are going to have to sell and lease up.
Yeah.
With soft rents, their carrying costs with their interest rates, their debt service payments way more than they thought. It's taking longer. They're giving concessions. They're leasing out with rents way lower than they pro forma'd. So they're in a race against time. It's going to be a big opportunity. And I think that's a good place, Matt, to hear a word from our sponsor.
Oh, all right. Great.
This episode of The Gray Report is sponsored by Gray Capital. Are you a developer of large multifamily assets and you are on a construction or bridge loan, underwater, debt service payments mounting? You've built a great asset at no fault of your own because of the excess spending of the U.S. federal government and actions taken by the Federal Reserve. You find yourself between a rock and a hard place. But rest assured, Gray Capital is here to save the day. If you're interested in a quick close in as early as 30 days, potentially all cash offers, any asset size 25 million to 100 million total capitalization. Click the link below if you would like a quick free quote for us to take that asset off of your hand. Again, 25 to 100 million dollar total capitalization. Close in as soon as 30 days. Get in touch with Gray Capital at graycapitalllc.com or click the link below. So, Matt, as we were saying, let's get into this Mortgage Bankers Association piece because I think that it talks a lot about kind of the mindset of the lending industry.
Yeah.
And from their perspective, now this is going back to the second quarter, but a lot of it's still applicable for today.
Yeah.
So
some of the stuff's a little old too. They have their interest rate projection at 3.875
for the 10-year?
No, not for the 10-year, for the Fed funds.
For the Fed funds, right? 3.75?
3.875 about at the end of 2024.
Well, that's just as, I mean, like, I love these little time capsules.
I know.
Because everyone, we don't know. No one knows.
Now, it would be interesting. Wrong. Now, and they also have unemployment at 4.6 and 0 for 2024 and 0.3 for the GDP for that year. So they may be, forecasting.
They thought there was going to be a recession.
Yeah, that's
which a lot of people did. So that no judging there.
I still am thinking about recession, and there was at least one article this past week that talked about how the discussions of recession are starting to bubble up again, and we're talking about how bad things are for multifamily operators and investors and all, and just across the board, you name it. I'm sure other industries have their own form of stress that these high interest rates are being.
Yeah, and it's very analogous.
Yeah,
I'd say. Not that. Yeah, very analogous.
Yeah, and so in that way, the Fed, these are the long and lagging, and the long and variable lags are also driven by a little bit of a denial that. Well, wait, no, things are going to be okay. Things are going to be okay. And so he has to make an Instagram to remind us that we're serious.
Yeah, it's hoping on statistics, which sometimes.
But to return to the report itself, it doesn't really throw a whole bunch of curveballs that we didn't already know about the multifamily market, but it does include some numbers that clarify the current state of things when it comes to multifamily lending. It's a Q2 report again, but it does show you, even though it's like a calm before the storm kind of thing, man, it shows multifamily loan originations down 51%. You also see the breakdown of different lender types, but I just thought that, as one data point, this decrease of 51% year over year, it is telling, and I think it says a lot about multifamily sales. Specifically, you can look at, so page 25 shows graphs on multifamily permits, starts, and completions, like we were describing. And it shows how starts have outpaced completions for the past few years in a way that I think stands out from the typical progression. And I was mapping this alongside like interest rates and recession periods. And this is not necessarily like predictive of recession. The way that these permits and starts are, it more is a product of the low interest rates at that time. And you can see at the end of this graph how the past quarter, so they only have kind of one quarter of data, how starts have just plummeted.
Yeah.
And I thought that was, it's almost invisible, but it's right there at the end.
Yeah.
And
zoom that graph in.
Yeah. So anyways, you can see how that's fallen off. And I'm wondering if Q3 is going to be even worse. But that's just kind of conjecture.
I mean, look at these negative numbers month over month. I mean, it's starting in December of 22, negative 24%, January 9, 16, negative 12, negative 5, 15, negative 16, negative 4, negative 26.
Yeah. It's really
starts the permits until a similar story, more or less.
Yeah. And I can't, and I'd like to know, I'm kind of interested to see what it typically is in the winter months. If it's anything like, previous years were do starts and permits lower, in the winter compared to the summer and spring. But another piece of information is on page 43 of this report. It talks about the different types of mortgage holders.
Yeah.
And that was helpful for me to get a picture of, all right, well, if we're measuring CMBS loans or CMBS loan maturities, how much does that reflect the
they're all about algebra?
Yeah, well, my question was, we have a report out that
it's about 8 million. So like 4 billion multifamily loans are coming due this month, another 4 plus or minus. So if 4 billion equals 12.9% of the originations.
Yeah.
This is second quarter 2023 though, not necessarily 2021.
Yeah,
it would be different.
Yeah, but so if it's the same makeup, let's push it down to 12.5, because then I could say it's 1/8.
or 10. Let's even just make it 10%.
Yeah.
10%. So times 10.
Yeah.
So that's 80. So it's 40 billion a month.
Yeah.
Yeah.
So there's a lot. My question is, so life insurance companies, are they issuing the same kinds of loans with the same kinds of maturities as CMBS? So CMBS, is that primarily those shorter term bridge loans and floating rate loans fall in that?
Most I think that they can be floating rate. A lot of the CLO is more of the bridge loan, from my understanding.
Okay.
But yeah.
And my other question is
the banks and thrifts.
Yeah, that was my big question. So the banks and thrifts are the largest.
There's banks, thrifts, and others would most likely be the bridge loans and the debt funds.
Okay. And so these commercial banks, and they call them thrifts, even though I think thrift is just a bank that doesn't have loans. So I don't know why they put that in. And either way, I'm quibbling. 38% is banks and thrifts. A clear plurality, not a majority, but I want to know. Yeah, I'm wondering, do they do floating rates?
Who?
The banks and thrifts.
Sure.
And we don't have data on that.
Most of it's floating.
Yeah. Okay. All right.
It's really it's the agencies that are really most of the fixed rate and some of the life co stuff, but it's mostly
very interesting.
That's fixed rate.
And if you scroll down, you can see how this makeup has changed throughout the years, and how specifically CMBS seems to have fallen off considerably. All right, so there's this other chart in the report where it shows the makeup of these loans at any given moment. So what was the proportion of CMBS loans to bank and thrift, and you can see how to put it short, how the CMBS volume of loans fell after the great financial crisis, while the bank and thrift portion has risen the most out of any other one. I think the agency one is like a linear. It's as linear as you can get.
But you can see. I mean, agencies really started picking up.
Yeah, it has ticked up.
Especially after 2007, 2008. So much of the distress in the commercial space was all tied to CMBS products.
See, I was surprised. I thought that agency would take up a larger percentage, because that's kind of what I'm familiar with and what we kind of look for, these longer term and agencies, and as such an attractive product. But
if we're just like talking about, but this is not just for multifamily, this is all commercial real estate and multifamily. And so in that context, it makes more sense, because the life insurance, I'm a little surprised that life insurance is so high and above. Is that the line that I'm looking at? The highest one is that bank and thrift.
The second lowest line is life insurance, and the lowest line is CMBS.
Is bank and thrift. That makes sense. Yeah, they're just okay. Yeah, that makes a lot more sense. Bank loans, because most commercial real estate. I mean, commercial real estate prior to 2006, 2007, it was like all CMBS, and then CMBS kind of, I mean, obviously didn't go away completely, but it became very unattractive. It's one of the most cumbersome types of financing you can get. Sometimes they can just turn it off. In COVID, CMBS market just stopped. They just turned it off entirely. And so that it was an immediate shift. Banks came in saying, "Oh, okay, well, we'll lend on office buildings, we'll loan on retail." Now the agencies, Fannie Mae and Freddie Mac, and bringing in HUD as well. They were around, but they became much more attractive in multifamily. And agency financing has been the most popular financing in multifamily. But bank lending still popular. In bridge loans are included in bank financing typically, and then also the rise of debt funds and a lot of non-bank lenders.
Spencer, you were right again. Now, this is just for Q1 and Q2 of 2023, but it does show agencies as the number one lender of the multifamily market.
Yeah.
Wow.
Yeah. Oh, yeah. Yeah, because I mean, they got government backed guarantee. Yeah. I mean, it's basically government, U.S. insured. The rates are lower. It's, if you want fixed rate, it's not the only place a bank can give you a fixed rate, but typically it's not. And it's relatively commoditized, and investors who are buying the bonds, they're still securitized into these big K loans. Investors love it, especially in a COVID environment, or when interest rates were lower, because you can get some good yield, and it was perceived as getting a much better. You're getting a little bit of premium, for not taking a whole lot of risk, because the default rates for multifamily are so low, less than way less than 1%, and so there's which this leads to potential other systemic issues of all these institutions that have been loading up on commercial real estate debt, and that the mark to market on a lot of those bonds aren't nearly as good. If you look at it today, the value of those loans today are underwater. Same thing with U.S. Treasuries.
So the value of like a Fannie Mae loan that an investor can get a piece of, that is worth less now than it used to be, because of the interest rate shift.
Okay. Yields up, price down. So the yields up for a new loan. If I go out today and I'm an investor, and it's a double whammy. So if I'm an investor, I go out, I want to buy. I want to go out and buy some mortgage-backed securities.
Look, and I just had that line graph up that showed what you described, how the agency picked up the pace from CMBS as well.
If you're an investor, I want to go out there today, and the yields are 7.5%. But I took out I bought a bond in 2020 or 21 or 2019 that was yielding 4%. That's a big difference. Wow,
it's like the SVB kind of thing, or was it Signature Bank?
Exactly.
Yeah.
So if you hold a bond to maturity, you just get your yield and it's fine. You don't lose money. But if you want to sell that bond beforehand, there's a net present value of those future cash flows relative to the prevailing interest rate.
It's all good as long as no one asks for the money.
Exactly. Or if you don't have to sell it.
Yeah.
But so not only as the price has gone down because of what rates you can get today, the demand has gone down also because there's other places where you can get yield. I can go into a treasury bond and get a super solid, return. I don't need an extra, basis point or two. Maybe I want it. Mm-hmm. But so that demand for mortgage-backed securities has decreased. And so the value's down. So it's just like the inherent, net present value has decreased, as well as just the demand for the product. And that's one of the reasons that, Ginnie Mae investors, Ginnie Mae bonds are the government insured bonds that, like HUD loans. When you take out a HUD loan, they're packaged in, they use kind of Ginnie Mae. It's kind of like their Fannie Mae equivalent, and these Ginnie Mae bonds that these bond investors buy. Big institutions, pension funds, whatever, banks, insurance, whatever. Mm-hmm. That there hasn't been that much demand for Ginnie Mae bonds. Because you're not getting the yields, you're not being as attractive. It used to be that on a HUD loan, again, backed by these Ginnie Mae bonds, mm-hmm. you get a lower interest rate than if you went with Fannie Mae or Freddie Mac, just because it was just the way it was structured.
Yeah.
It was perceived to be even lower risk. There's just no demand for that. So the interest rates are higher.
I wrote writing these rates for the last week. This morning's newsletter, really, and the HUD loans. I think they're more than Fannie and Freddie.
Yeah, which never used to be the case.
Yeah,
and you can sign up for our newsletter. By the way, link below in the description. GreatCapitalLLC.com/newsletter.
You can see how I am getting use out of it, even personally.
Yeah, everybody. Right. Matt. Speaking of the newsletter, and again, the link below in the description. It's so cool to see. Like, I see people imitating
mm-hmm.
the newsletter time and time again.
Yeah.
It's cool to see. I mean, it's because ours it's still the Group Report's still the best newsletter.
Oh yeah.
But people have caught on. I think there's a demand for this type of information.
Mm-hmm.
What we're doing, what you're doing.
I feel like a proud father.
Yeah, exactly. It's good stuff in having these conversations.
Yeah.
So, Matt, anything else on this this piece from the Mortgage Bankers Association?
Not necessarily. I just wanted to show what the makeup of these lenders are, and it can kind of give you an idea of what to expect. If you know that, okay, a lot of these loans are locked up in longer term, but there is a sizable portion that are shorter term, and I think that those shorter term are going to be vulnerable. Even if maybe it's only 40% rather than 60% of the loans that are out there. I don't think that everyone is in the multifamily lending market is insulated from the dramatic shifts. And I know I'm repeating myself, but when I'm talking about false hope and stuff, but I think there is a whole lot of motivated communication that there is no reason at all for them to admit that there's going to be a problem until the very last moment, because what good would it do? So
yeah,
we may not know about this until that horrible phone call starts.
The only way someone's going to find out about it is if they're subscribed to the group.
Oh, yeah. We're the first person to find out. They're going to know when they get that phone call from the creditor that's like, this is it. and then that person, the next phone call is to us, is to the Great Report, where we report on it.
I think we get the first call.
That's true, actually. We will be calling you.
Did you see the latest episode?
That's great. That's funny.
Sometimes I hear Jerome Powell speak, and I'm like, I think he watched the episode last month.
Wait, you think he's speaking directly to you?
No, I didn't just listen to it. Oh man,
I think he may be.
Too much.
Yeah,
all right. Joint Center for Housing Studies, Harvard, always putting out really informative pieces from a different perspective than a lot of the kind of the multifamily industry publications.
This was really short too. So it really looks at, it's just honestly a reminder of what we've been talking about and covering, which is that in the single family world, it's roughly the same kind of, I don't want to call it false hope, but low sales volumes for sure. And they're driven by this huge gap between the bid and the ask. Or, what's unprofitable for investors is it still doesn't make sense for buyers of single family homes. And because there's so little inventory and they're still getting bought up so much, the payments that you're going to have to make, whether, for mortgage, are still creeping up. It's still getting more expensive because of the combined effect of high interest rates and home prices.
Mortgage rates past 8% yesterday.
Yeah. I was reading things about how that's like some magic threshold. And that was another thing that I was thinking about with this, and then the apartment list rent growth report, and just this in general. It's like people are still thinking there's a lot of wallets that haven't gotten used to the price hikes of last year and the year before. Like they don't forget that daily or monthly burden that maybe housing prices. And that was that was specifically connected to this article on where a Biden economic advisor has said that housing prices still remain a big burden for people. And just like I said, like they're not coming down. And I don't know what it's going to take. And the economic advisor didn't really know what it would take. It's like hard to fund affordable housing in this environment too, because of the interest rates.
Hard to fund anything right now.
Yeah.
I mean, because
the government can't do it.
It's hard to, and that I think is the biggest story.
Yeah.
That again, I haven't quantified, but it's the same story for everybody. I mean, the whole world economy is built on debt.
Yeah.
And we've been addicted to low interest rates for so long. We're just in the first stages of withdrawal.
Yeah.
And we haven't really gotten the shakes yet. And it's not just real estate. I mean, real estate's a big part of that because it's a big part of the economy, and it's a leveraged part of the economy. But it's every business. It's most households.
Yeah.
Fortunately, households are on fixed rate debt for their primary mortgages for the most part. But it's the government. It's the federal government. We're spending all this money. We're financing all of it.
Yeah.
Our interest payments, relative to GDP, and it's insane.
Oh yes.
And it has to impact what we can do in future stimulus and spending and it's maybe the restraint that we've needed.
Yeah.
But
not it's worth mentioning that there may be another rate hike on the horizon, or at least that's the word on the street. People are bracing for that.
Do you think that because on this topic, Matt, 10-year Treasury, 4 point, what was it? Yeah, you did the report. It was 4.7,
so or maybe
this morning. Fact is, it's
I had the graph up.
It's working its way to 5%, and we're at 4.71. Today. That is, I mean, again, we were at 0.4% not too long. I mean, or back in the pandemic, and we're approaching 5. So it's, does the Federal Reserve need to raise rates? I think they certainly need to they're going to talk about it to make sure everyone knows that they're serious. I think people are taking them serious now. They're higher for longer.
Yeah.
But, the market is taking, care of a lot of it because, deals that were on the margins, when the 10-year was 3.8 not too long ago, well, that doesn't work anymore.
Yeah.
You're at 4.2, a couple of weeks ago. Well, no, we're at 4.7. The deals it's not like the deals had a lot of margin of error to begin with. Every asset that was on this, I'm not talking about real estate, again, businesses, everything. It's the price of money.
Yeah.
It's the rate we were paying, you're paying for time. And, that's just changed. Everything is like affected in relative to this.
Yeah.
And so, in some ways it has just as big of an effect than it's the Federal Reserve moving the Fed funds rate.
Yeah.
So the work is being done for them. And the big question that everyone has is what will break next?
Yeah. Yeah. And it is increasingly seeming like something's got to break because people will willingly live in a delusion rather than try to get ahead of any problem. Like you could tell someone, take this. It's like preventative medicine. They're not going to take the preventative medicine. They're going to wait until something actually goes wrong, until the crisis hits before they'll swallow.
Yeah, wait for the heart attack.
Yeah,
not going to take cholesterol medicine. Definitely not going to eat right.
Yeah, yeah.
Let's bring it to its natural conclusion.
Yeah.
Matt, Apartment List has got a research report.
Yeah, this really just it's a nice kind of ending point and characterizes a lot of what I've said before about the multifamily market, and really about kind of like the future and what might happen in the next coming months.
The future now.
Continued rent growth slide. The future is now a little bit, but it's going to get worse it's going to get worse. And that's what people need to put this in mind is it was a cold winter last year. It's going to be another cold winter for rent growth this year. That should be a factor in how some operators and investors are thinking about the cash flow of their properties for the near future. Maybe it will dim some of that hope, but who knows? The rent drop for this September was a little bit stronger worse than last year's 0.4. So what I think is that we could see a similar fall in rents as we did in the winter of last year. Only this year, we're going to see negative year-over-year numbers as well as negative month-over-month numbers. Fortunately, and there's a RealPage article that has similar information as this Apartment List article, the vacancy and the kind of general demand trends are looking more positive, I think, than the rent growth trends themselves. We're about at pre-pandemic levels of vacancy, but we're not increasing. The vacancy is not increasing at the rate at that it used to, and it very much looks like it's plateauing or maybe even going down. But that's a case for the future, and I'm not going to hope. I do think, though, especially supported by this RealPage article that showed robust apartment demand, that the fundamentals are strong, but we've got so much new supply that we're dealing with. It is it's another story of the huge increase in supply, and if you want to know how big of a supply affected, you can look at the top performing markets that are in this Apartment List report, and there are 0 Sunbelt markets there. If we're looking for over the past 6 months, the fastest metro level rent growth gains fastest metro level rent growth among the 51 markets they cover, nary a Sunbelt market to be seen in the top 10 over the past 6 months. Well, that's over the past 3 years. That's the past
3 months.
And if you look at the past year, there is no Sunbelt market. We've got I'm just looking at the year one. So the strongest multifamily markets of the past year is Hartford, Connecticut, Milwaukee, Wisconsin, Chicago, Illinois, Tucson. Oh, I was wrong.
It's
an exception that proves the rule.
To Southwest.
Yeah. But
it's pretty sunny though. It's quite sunny.
for everyone else is not Tucson. No, there's Louisville, Kansas City, Providence, Boston, New York, Indianapolis. So I'll have to qualify that with it's dominated by non-Sunbelt markets. And I think that the reason why is because developers came in and built a lot of apartments in those Sunbelt markets, at least more so than they did in the Northeast. Now, I don't know I don't have the numbers up that can correlate how much, supply or how much new construction is relative to current supply for all these markets. But man, it sure fits the broad brush story that we were talking about for the past 3 years. The developer, high rent growth happens in the Sunbelt. Developers rush down there, build a bunch of apartments, and now there's lower rent growth down in the Sunbelt. That's the kind of
Matt. We may be single-handedly moving the month rent growth in Terre Haute.
33.7% since March 20th, and then
but month over month
3.9 is incredible.
Year 14.5.
Yeah, obviously it's the quality living arrangements that we offer, and really well managed. Who wouldn't want to pay a little more to live at a great capital property?
Exactly.
But the upshot to all of this is that I think that the longer term. So this is it's a kind of a near term, long term situation where if your long term is measured in months, then you're going to have a bad time. If your long term is measured in a couple of years or maybe even a year, then we'll get through this and things will get back to normal. Because for one, another big story is that they're not building new apartments. They're not starting to build. The starts are way down, like we saw in the Mortgage Bankers Association. Starts are way down, so they're not starting to build. And but But in the meantime, we're going to see a lot of new apartments, and that's going to drive rents down. You just have to wait it out.
Yeah, we're closer to the beginning than the end in many cases. He had the light. He said light at the end of the tunnel.
Yeah. Unless you have that horizon that can fit within like years rather than months, then you could be in for a world of hurt. And then what you'll do, your way out is going to come after, after a lot of suffering, when it could have just come, you could have just solved your problem before the pain.
Matt, the yield curve is reverting.
I was noticing that. I was like, well, what does that mean? That it does look like it is reverting. And I'm not a follower of the yield curve. I don't.
What do you mean?
I don't follow it enough because it's been inverted for so long that I'm like, well, what is there to see? But I am curious. Everyone says if the yield curve is inverted, it's just a matter of time till the next recession. Well, what is the common? And I'm sure that I can find a Barry Ritholtz article about this. What is the average time period between inversion and recession? And
6 to 18 months.
Okay. And what would these guys make of the fact that it's been inverted for so long?
I'm going to show you on the chart.
We all get used to it. It doesn't matter anymore. That's what I think.
I'm going to show you on the chart, man.
All right.
If it shows the recession.
Oh yeah.
Because it's yeah. I'll let you, Matt, make your own assessment. Once it's been inverted, what happened? Oh wow, it's reverting, and then what happens? What the gray, what the shaded lines are.
Yeah, those are the recessions.
Okay, yeah. So it inverts.
Do we have this up on the screen?
No, I don't have that screen, Matt. No one needs to see this.
All right,
I'm kidding. Let's get this on the screen for all the folks at home watching on YouTube. Make sure you subscribe to Great Capital YouTube channel. You're going to get all this updates and more. So Matt, so you see here, I'm not trying to be like, let's just look at the charts, but you have the inversion and then it reverts, and then the recession. You have an inversion and it reverts, and then there's a recession. You have an inversion and then it reverts, and you have a recession. So
the reversion happens.
Oftentimes it's because something in the economy has broken and the Federal Reserve lowers interest rates and reverts it on its own. In this case, the further end of the curve is finally kind of matching up. It's a lot of it is kind of the same effect, cause and effect. So take that way you want to. If you want to believe any of this, what does the reversion mean? Well, it would mean that maybe if there is going to be a recession, maybe not a deep recession, maybe just bumpy landing of sorts. I don't even want to qualify it, but the thing, the whatever the thing is that we've all been maybe waiting for, which maybe we never get, but whatever the thing may be, whatever form, it may be on the doorstep, a couple months. Yeah, maybe it's just, but then it's like everything. The base cases are so different. Everything is rejiggered, and so maybe it could be worse. It could be worse. It can mean nothing because the pandemic just shook everything up to where signals of the past and indicators just don't tell us what we think that they are. So we could be reading into it too much. Yeah. But if we do believe that, 18 months later, and now it's reverting, we would be on track to that. So it's hard to say that, without knowing what the next. Yeah, it certainly looks like well within the pattern. Looking at that graph didn't look like we're in an abnormal period. Like it has been. And there's a couple months, it reverts, then there's it's like a month or two later, and then and we've been talking about this period in time for I don't know 6-8 months to a year of potential catalysts, not really knowing what the details are, but there's enough smoke in this time period where it's a cause for concern. Well, and again, to come back to this hope question, I was talking beforehand. I was like, well, people, you got to snap out of it, and is recession going to be the thing that snaps the market out of it? And it's like, where they look like an idiot for bringing it to market at the prices that they do, because everyone's hurting so much. And then if they don't get ahead of that, that's what we were. And I've been saying this for a year, but what is going to shock these people that they think that, oh man, the next few months are really going to be horrible and I can't survive it.
And a recession would seem to bring a lot of those conditions.
It would be kicking a lot of people while they were down, and a lot of people would just give up. They just throw in the towel. Maybe, perhaps, not all.
And that's why I don't want, because I think recession would be bad for everyone if it's. It will allow some opportunities to come up, but the costs of those opportunities would be a lot worse than I'm hoping.
I'd much rather just interest everything normalize and interest rates, come down a little bit, and cap rates, maybe expand just a little bit. Everything makes sense, and there's not as much pain. We keep going, and no one loses their jobs, and no one loses their deals. Just people don't make as much money as they did on some of them. Like that would be awesome. I don't think that's really going to happen. Unfortunately, I think there is going to be some pain. People lose their deals. People are going to go out of business.
And the fact. So, the fact that we're talking about this, and I said, it's probably helping in other lines of work too, that are, relying on these low interest rates for whatever reason, maybe to even make payroll. It is, this continued pressure. And I'm thinking how long can it last? And to think that it could last a whole nother year, then something's got to give. And that could be the real catalyst, is just like, all right, it's not like a housing crisis, or, it may not start in one sector and bleed over to everything. It just may be a general, a general slump that everyone feels.
Yeah.
And to repeat myself, that is something that I have, maybe it's my own personal bias, or maybe I'm getting algorithmed or whatever, but I've noticed discussion of the possibility of recession a lot more in the past week or two, and it seems to be more compelling of a discussion than it was at the beginning of the year. There were a lot of people talking about it.
Again, we're on the 3-4 week cycle, man. Yeah. Literally, everyone a couple weeks ago were pretty certain, including, we were talking about okay, if nothing else happens, 10 years probably going to keep, sliding down, and maybe it'll be, people were thinking 3.5 was totally reasonable, place a 10-year treasury might be at the end of the year. And people were seriously saying well, for a long time, the Federal Reserve will start lowering the Fed funds rate. About a month and a half ago, people were like, it's not going to happen this year. But still, people were thinking the Federal 10-year was going to start coming in. But now when it's, marching its way till 5%, and certainly Jerome Powell's speech and Jackson Hole and some other comments in some other Federal Reserve board members saying, no, higher for longer, get ready. Maybe spooked the market a little bit more, but certainly it's reacting and the market's speaking. And we're getting to levels where I think people are more certain that some things will break what the first things are.
It's almost like actual bad things have to happen before people can be afraid of more bad things happening.
And so these companies also have been thinking, man, so it's really been 3 weeks since we've been 10 years higher for longer. The conference, so that would, the hope is being eroded. And those conversations probably haven't finished over the last 3 weeks, and decisions are being made in that time, figuring out, trying to raise capital, talking to different preferred equity brokers, looking at community friends. How do we fix this? How do we fix this? And then that's we're getting communications from brokers being like, guys, get ready.
So and this is just something that I read, and I forget if it was in one of the articles here or elsewhere that was find it in the newsletter. But a lot of the speculation is that Q4, when it comes to loan maturities and interest rates and banks letting people off easy, Q4, they'll probably extend it into Q1. They'll probably say, listen, I don't want to deal. We can renegotiate this in Q1 when the sales market is kind of reset and everything's a little bit more fresh and people are more amenable to finishing things out. But we'll let you limp along for these next few months. So I wonder if that's going to mostly happen. I still don't foresee a bunch of wholesale forgivenesses. I also don't foresee things getting any better in January than they are in October.
Certain things change, but what would?
And I, as a student loan borrower, I know when a lender grants me a forbearance, it's like, all right, we'll just see your principal raise up. That's fine with me. They love that.
Have your student loans begun again? Or?
I need to check up again, but I'm assuming so. I need to get on.
Not to strike up.
Oh no, well, it's fine. And yeah. Well, that's another topic that we should cover.
And again, not to get too personal, but is it like is it like not that big of a deal, or is it like this is gonna suck? Or again, I don't want to get personal.
And you can imagine how much I make, and you can also imagine I almost have that much in loans. So I've got a lot of loans. I make about whatever, and I still qualify for an income-based repayment plan. Yeah. And I did a little calculator.
We don't want to give you a raise to Matt.
Yeah, that's gonna. Dang it! I was factoring before and after. All right,
if you do the math.
Yeah. But that's true. Don't give me a raise so I can stay on my income-based repayment.
Yeah, crazy things happen. Find another way.
Yeah. But there are income-based repayment plans, and it is a pretty decent solution, at least for me. I file separately for my wife so that I can kind of separate it. It's just me. And it's not a huge for people. Yeah. If you want to pay them off, great. I'm mad that I can't refi. I'm never able to refinance them.
Yeah. Well, but now are they floating rate or are they fixed rate?
Oh, good question. I don't know. They decide whatever they want to do.
Yeah. Whatever.
And that's what my joke was like. So they can steal my identity, and all right, you get a lot of loans.
Yeah.
But
Biden announced another $9 billion of.
Well, and that's another thing too. Is there's forgiveness things that are floating around. I think that, and I may have mentioned this before in an episode with Addison, is the idea that if you're on an income-based repayment plan, that interest may not accrue, or there are elements where your principal is not like accruing and getting larger and larger. If you don't make those minimum payments, that's not going to just increase.
Yeah.
I think that's going to be really meaningful for people, and it may blunt the impact of all of these student loan borrowers, which are really like the target demographic for a lot of apartment communities.
Yeah.
And so I think that is a particularly relevant topic. But I'm really paying attention to what Biden does. And, you may have a political and ideological stance on it, but I'm going to take everything I can get from Biden or from any administration.
I just hope Kamala runs.
All right. Do we want to end that? Do you want to end it there? Yeah. That's fine.
That's a non-political statement. That's like a universal thing.
Yeah. Well,
maybe not.
I think that, that is an unseen factor that that I'm going to dig into in this week is, I'm sure that plenty of people are talking about it, but, man, how much of the economy as a whole was buoyed by the absence of student loan payments?
It's a good question. I think,
at least in the apartment,
I don't believe people saved it. I think people spent it.
Oh yeah. You're a dumb, recently graduated student.
Yeah. Just taking the average American spending habits.
Yeah.
It's very clear.
I think I read one article about people that were that
saving them
speculated that they had saved up all this time and they're going to pay it off now. Which one person did that in America that you have to write the article about?
I mean, the one that's like making so much money they could have probably paid it off anyway.
Yeah.
The 1 or 2%. Well, Matt, this was a great report. I want to thank our sponsors, Gray Capital. Thanks.
Yeah,
you're welcome.
If you would like to be a sponsor of the Gray Report newsletter or podcast and YouTube series, you can contact us at matt@graycapitalllc.com, and I will respond personally, and we can talk about how you want to be featured.
Don't give Matt any ideas. But if you are a developer or owner of a large multifamily asset valued anywhere between $25 and $100 million, and you are looking to sell and avoid future pain, click the link below. Get in touch with the Gray Capital team. Go to graycapitalllc.com. You can close in as quick as 30 days. And again, $25 through $100 million total capitalization, ideally in the Midwest. The newer, the better. The better the location, the more interested we will be. But get in touch with us. We can give you a free quote on what we could pay you to take that asset off of your hands in as quick as 30 days. Want to make sure you check it out. And that goes for lenders, anyone who may be in a receivership situation. Let us know. We are ready to go. Dry powder. solid as a rock.
Sweet.
All right. Thanks for watching the Gray Report. Hope you have a great rest of your week, great weekend. Stay warm. Let's make some really good decisions. Make sure you're subscribed, and we'll see you on the next episode of the Gray Report.